in terms of helping people to deal with business succession planning and all the family matters that go on. I can assure you that the family matters part of it is very important, because unless you have your act together that way, you can be sure your tax planning is not going to succeed. It's almost a certainty, and disaster will follow in terms of possible loss of the farm as well as destroying the family. With that, I'd like to go to the second slide. And that is one which shows statistically just how important it is for people to do planning in terms of these farms, because 70% of farms don't make it from the first generation to the second, 90% don't make it from the second to the third generation, and a whopping 96% never get to the fourth generation. So what does it tell us? It tells us that farmers and ranchers need to refocus their attention on serving their own business planning and family needs in regard to these properties. Now, I asked myself, what's the best way of conveying these planning concepts to an audience like yourselves? And I've concluded that the way to do it is through a form of a story. Why? Because it's easier to follow, you'll remember it, and secondly, when you see the facts that we'll see here, it'll bring to your attention the opportunities that are available. And we're going to begin with someone by the name of Bill, who, like so many farmers, like the shoemaker with holes in his shoes, is so preoccupied with taking care of his daily events, he doesn't take time to plan for the future. Now, his factual situation is such that Bill is, we're going to assume, 60 years old. He's got a wife, Sue, who's 58, and he's got 3 children. The 2 boys, James and John, are employed on the farm, actively involved with it. But the daughter, Nancy, who's 28, is a school teacher, and really doesn't want to be involved with the farm. Now, the farm happens to be worth $20 million. 50% owned by Bill and 50% by Susan. Their total net worth is $25 million. Now, I will say this to you. Those are large numbers, perhaps larger than many of you think you'll see in the people you deal with. But I'll caution you, I had to use numbers this large because this year, the federal state tax exemption, and I'll explain what that is later on, happens to be $5.12 million. However, come January 1st of 2013, the way the law stands right now, that exemption drops from $5.12 million just to $1 million, which means a lot more people are going to have farms worth that much and more to be concerned about this. Yes, Congress may change the rules. We've got to see what that means. But for right now, I think it's important that people pay attention to this, even if their farm isn't worth $15 million. Now, what are Bill's objectives? First, like many people, he wants to keep the farm in the family, which means in his case, he and Sue, his husband and wife, want to see this farm owned by their 2 sons, 50% each, after they're both gone. Secondly, their daughter Nancy is their child also, and they want to see her treated fairly. And finally, Bill and Sue, like so many farmers with a substantial operation, have employees. In this case, the names are Charles and Jane, and it's important to the success of this farm and its ongoing viability that they keep those key employees around. Okay, what are Bill's succession planning needs? For simplicity's sake, I think we can break it down to 3 categories. For this succession plan to work, it must have 3 elements in place. First, we have to have enough money. Secondly, we have to have the right people in place. And thirdly, we have to have freedom of operation so that we can succeed. Now, enough money comes in 2 respects. First, we have to address Bill's estate tax liquidity needs. And then secondly, we have to be concerned with the possibility of his premature death and what that can mean to the farm. The problem we face with regard to the estate tax is that the value of farm and ranch land, when added up, can expose the owner to federal state tax. The problem, however, is farms are typically not cash cows, which means that you've got to file this estate tax return 9 months after the person's died, and generally speaking, you've got to pay the tax with the return. How do you come up with that much cash just 9 months after someone's died when they're in a farming business? Sadly, in many cases it happens, they've got to sell all or piece of the farm. And that's what we hope to avoid here. Now, I mentioned before the federal estate tax. Just how much is it? Well, the tax applies to the person's taxable estate to the extent it exceeds what is called the applicable estate tax exclusion. For 2012, as I mentioned earlier, that exclusion is $5,120,000, which is to say that if you're worth less than $5,120,000 when you die, there's no estate tax. But also, as I said, come January 1st, 2013, that number is going to scheduled to drop by law to just $1 million. Not only that, but this year we have a 35% estate tax rate. Next year, January 1st, it jumps to 55%. Think about that. Just $1 million exemption and a 55% tax on value in excess of that. Now, here's an example of what happens when people have got a farm worth $15 million. We take the $50 million value, let's say it's a gross estate. We deduct from that this $5,120,000 exclusion. We have a balance of $9,880,000. Take that time this year's 35% tax rate, and we see they owe just about $3.5 million in taxes on this farm. I ask you again, who can come up with that kind of cash in just 9 months? Well, there are techniques that people can use to reduce their estate tax exposure. But they typically involve two very important realizations. Number one, you have to first change how you own or manage your property. And secondly, you must make large estate-reducing gifts to the next generation. Well, what's wrong with that? What's wrong with it is as people get older, they don't like change. And the best example I can give you is my wife's own family. They own a large farm that straddles the Georgia-Florida border. And I announced to the family after my father-in-law's 80th birthday, I was going to make a presentation to the family on why and how we should establish what is called a family limited partnership. You'll see in a few minutes why that's important and what it accomplishes or can accomplish. So here we are, mother and father-in-law. He's 80, she's 78. The three daughters, including my wife and their husbands. My wife's aunt, who has a like problem with a ranch she owned. Just as I'm about to speak, my mother-in-law stands up. She blushes and says, "I have to get my hair done." I'm like, "What, now? You know I was going to speak about this." Well, my father-in-law smiled and said, "Lou, let her go. She'll come around." And eventually she did. But what was she really telling me? Was she saying, "I must have my hair done," or was she saying, "I don't want to hear this"? I submit to you, it was the latter point. She was basically saying to me, "I'm 78 years old. We've run this farm our way for over 40 years. And now I understand you're going to tell me that we have to take our farm and put it in partnership." Well, that's going to change how we do our accounting. It's going to change how we do our taxes. It's going to change how we do our banking. I don't want to hear this. Not only that, but I understand that then after the partnership is formed and the farm is in it, then I have to give large gifts of these partnership interests to my daughters. What if one of them gets divorced or gets into a bad business deal? What happens to our farm? As you can see, older people have reservations about getting involved in the sophisticated planning techniques that are designed to reduce their estate tax exposure. That's why I come to what I call the palatable alternative, and that is purchase life insurance to cover your estate taxes. It doesn't require changing your life. The premiums are an affordable alternative to large estate-reducing gifts. And not only that, but we have the ability this year with this gift tax exclusion to transfer significant amounts of wealth to the Roth Trust, cash that is, to pay the premiums on the insurance. Now, there's a problem, however, that must be addressed, and that is the fact that if the person buys insurance to pay their estate tax when they die, but they own that insurance when they die, the insurance will be included in their gross estate. Now, keep in mind that you wouldn't want to buy insurance to pay estate taxes if in doing it you cause the insurance to be exposed to tax itself. That just doesn't make sense. So the alternative, the solution, is not to buy and own the insurance yourself, but rather to go to your lawyer, have them for a rather modest sum of money, set up what's called an irrevocable trust that's authorized to buy insurance. You make gifts of cash to that trust, and the trust uses the cash to buy the life insurance. That way, the life insurance won't be in your estate, and the entire amount will be available to pay estate tax when you die. Okay, Our second question with regard to having enough money is what is going to happen to the value and survivability of this farm if Bill dies prematurely. Keep in mind that since he's running the operation, we may have a loss of income because he's been out there not just farming, but also taking care of generating revenue, selling our products. Not to mention the fact that we could incur additional expenses in having to hire people or other resources to make up for the loss of Bill and his services. So what's the answer to this? The answer is Bill needs to buy a key person insurance policy himself through the farm so that when he dies, that cash will be there to offset additional expenses incurred with his death and also the loss of revenue associated with the loss of his services. And that's what you do. You add up what we estimate is lost revenue and additional expenses, and you buy a life insurance policy to cover that. That leaves us with the second major category of concern, and that is having the right people. First of all, remember that we want the farm to go to James and John, the two boys, after Bill and Sue are dead. Next, let's not forget Nancy. She's a daughter. We've got to be fair to her. If the boys are getting the farm, she needs to get something too. And lastly, remember we've got to keep those two key employees to help running this farm through the transition. Looking at getting the farm to the two boys, James and John, we've got four choices. The first one is just give it to them as a gift. Secondly, we can sell it to what's called a grantor trust for their benefit. I'll explain that. Or we can set up what's called a grantor retained annuity trust, or GRAT. Explain that too. But finally, we can have a buy and sell between the boys and their parents, and we'll get around to that as well. Looking first at the idea of the parents making a gift, the first question they should ask is, can we really afford to do that? And if we can, what are the gift tax implications of giving the farm to the boys? And here, as I'll explain in a few minutes, they should think about restructuring that farm in the form of ownership to be able to take advantage of discounts on the value of the farm when they make those gifts. Now, whenever you talk about giving something away, you must understand that there is the gift tax out there. And you want to be careful that you're not exposed to the gift tax so that besides giving the property, they've got to pay tax to the government. We have two very important tools to deal with in minimizing that gift tax exposure. The first is the $13,000 per year gift tax exclusion, and the second is this $5,120,000 gift tax applicable exclusion. Looking first at the annual exclusion, it's a real simple rule. All it says is that you can give as many people as you want, $13,000 a year, every year for as long as you live, and there's no gift tax on the transactions. That means that also if you're married, you and your spouse together can give twice $13,000 or $26,000 a year to as many people as you want year after year. So here's our example. Got a mother and father, you've got 3 children, and together they want to give each child that $26,000, adds up to $78,000 a year they can give away gift tax free. Think about that for a minute. How many years a person's going to live, and at $78,000 a year in a case like this, they can give quite a lot away gift tax free. Now, besides this annual exclusion of $13,000 per year for an individual or $26,000 per couple, we have this $5,120,000 gift tax applicable exclusion this year. Now, you need to understand that you can give that away in addition to this annual exclusion amount. So let's take a mother, let's say she's single, and she decides to give her child $50,000 this year. The first $13,000 is absorbed by the annual exclusion of $13,000. The excess, or $37,000, is absorbed by the $5,120,000 applicable exclusion. So that $5,120,000 drops by $37,000. And she could do this year after year, theoretically. Next, I mentioned before that if they're going to give away this farm, besides these two tools of the applicable exclusion, that's the $5,120,000, and the annual exclusion of $13,000 or $26,000, they need to think about what they can do to get discounts on the value of their gifts so they give away more property for the same amount of exclusions. And the answer is for Bill and Sue to think about forming what is called a family limited partnership, just as I had my mother and father-in-law do. Once the partnership is formed by the lawyer, they transfer the farm into the partnership and receive back partnership interest. They can then turn around and give those partnership interests to their children using their annual exclusions and their $5,120,000 gift tax applicable exclusions. Okay. When they do this, I mentioned here in the slide, they're going to be entitled to discounts. Why? What for? Again, the example of the family farm. My mother and father-in-law formed this partnership, and they've given partnership shares to my wife and her two sisters. Would any of you care to buy one of my wife's partnership shares? I submit the answer is probably no. And the reason is that, first of all, you're not a part of the family, you're getting minority interest, and no one's going to pay attention to you. Secondly, should you be so foolish as to buy one of those interests, who could you resell it to except at a very steep discount? And that's why, when we value the gifts that the parents give to their children, we take gifts, I should say, discounts for what are called lack of marketability and a lack of control. The courts have looked at this and they've agreed these are realistic discounts, viable discounts, they're legitimate, you can use them. And they typically run about 35 to 40%. Let's see what that means in terms of real numbers. We've said already that this farm is worth about $20 million. Without discounts, Bill and Sue in 1 year can give their 3 children, well, let's say the 2 sons in this case, because they're the only ones who want to be involved, but they can give the 2 sons altogether $10,292,000 of family partnership interests, except that, remember, we're going to say we've got a 35% discount on these transactions. Applying a 35% discount to the $10,292,000, it turns into $15,833,846 worth of partnership interests that are going to the children, the 2 sons, gift tax free. Now let's go back for a second, because you may be asking yourself, where does $10,292,000 come from? It's comprised of giving each of the boys $26,000 in partnership interests in the first year using the annual exclusions. That's $13,000 each parent, or a total of $26,000 to each son. That adds up to what? $56,000. Now, if you add to that, I'm sorry, it's more than that. No, it is 56. If you add to that each parent's $5,120,000, that's where you get to the $10,292,000. Applying a 35% discount, it grows to $15,833,846. Basically, by using this partnership vehicle at the discounts, we just gave away 1/3 more of the farm, gift tax free. Next slide. Besides giving this farm to the 2 boys, let's think about a possibility of selling it for their benefit to them and doing it through what's called a grantor trust. Well, the first question should be, what's a grantor trust? It's very simply an irrevocable trust set up by the couple's lawyer that contains 1 or 3 provisions, or possibly all 3. The trust states that the trustee can buy life insurance on Bill and Sue and use trust income to pay the premiums, or the trustee can loan money to Bill and Sue at interest but without adequate collateral, or thirdly, the trustee can exchange assets with Bill and Sue for assets of equal value. Any one of those 3 features in the trust, we get ourselves a grantor trust. The next question should be, so what? What does that mean? What it means, crucially, is that we can ignore transactions between Bill and Sue and the trust for income tax purposes. In a few minutes, you'll see the significance of that. Okay, we've got the trust in place. It's a grantor trust, and Bill and Sue now make a gift to the trust of $2 million. I know the screen says $200,000. That's a typo. They're going to give $2 million to the trust as a gift. It can be cash, marketable securities, whatever. After that's done, the trust is seated. They then turn around and they sell the farm to this grantor trust for an installment note. Then, going forward, the trust owns the farm, and it has also the $2 million of the gift that they gave. Using the income from the $2 million gift and the farm itself now inside the trustee can take that income and use it to pay the installment notes held by Bill and Sue. Now, since it's a grantor trust, Bill and Sue will pay the income tax on the trust earnings, which means the trust has that much more growing income tax-free that it can use to pay the notes. Secondly, recall when I said that as a grantor trust, we can ignore transactions between the trust and Bill and Sue for income tax purposes. What that means is that the trust does not have to recognize any capital gain on the sale of the farm to the trust. Keep in mind, that farm might be worth $20 million today. That Bill and Sue might have bought it for $2 million 20 years ago. That's an $18 million capital gain. If that were the case, we can ignore it in this transaction sale to the trust. Think about that, saving that much capital gain. Next thing, the farm and any future appreciation on it are removed from Bill and Sue's estates, which reduces estate tax exposure. And finally, Bill and Sue are going to receive income from the sale of this farm to the trust because the trust is paying the installment notes to them. One caution, if Bill and Sue were to die with outstanding unpaid notes, those notes be included in their gross estate. So if we used, let's say, 10-year installment notes, we could solve that problem just by buying a 10-year term insurance policy would cover any estate tax to be a decreasing term on the notes. That would cover the estate tax exposure. Going on. A grantor retained annuity trust. This is nothing more than a situation where Bill and Sue go to the lawyer. He sets up another irrevocable trust. They transfer the farm to the trust in return for right to receive income for a period of years. At the end of that term of years, let's say it's 10 years, at the end of that term, the trust terminates and the farm goes to the two boys. Now, here's the key. When this trust is set up, let's say it's today, we know that at the end of 10 years of income being paid to Bill and Sue, the trust will terminate and the remainder interest goes to the boys. That remainder is a gift to those boys. We determine the value of that gift now when the trust is set up using government discount rates. Here's the key. Where are interest rates today? They're very low, which means the discount rates are very low. If that trust, with the farm inside of it, produces a rate of return that's higher than those government discount rates, which it's likely to do, that means this remainder interest that's going to the boys will be undervalued for gift tax purposes. It's another way of transferring the property to the boys. Only this time, they're getting income from the trust, and they're getting a break on the gift tax value, the remainder going to the boys. It's a win-win situation. Now, the only risk is that if they die during that 10-year period, when they retain the right to income, the farm comes back in their estate. But again, we can solve that by selling them a 10-year term policy, because at the end of 10 years, that exposure is gone, and the property is out of their estate. The advantage, again, Bill and Sue didn't just give the farm to the boys, they got 10 years of income in doing it through the trust. And as I said before, they live to the end of the trust, there's no exposure, the farm won't be in their estates. Now, let's talk about a buy and sell agreement. How about if the two boys enter into a buy and sell agreement with their parents, the terms of which say that after the death of Bill and Sue, the survivor's estate will sell the farm to the two boys at a price stated in the agreement. Now, to fund this purchase price, the two boys will buy a second and die life insurance policy on the parents. They can buy it together, or they can buy it through a partnership. There are advantages both ways. Anyway, after the second parent has died, the two boys collect the death proceeds from the insurance company, turn around and buy the farm from the second and die parent's estate. They got the farm. Now, key point. Whether Bill and Sue give the farm to the boys or they sell it to them, there's still the daughter Nancy, who the parents want to be treated fairly. How do you do that? Let me tell you a story. I had a situation where I and a former consulting partner were making a presentation on succession planning to the North Tampa Chamber of Commerce. And in the audience, I could see a couple sitting there staring into space. And I said to myself, something's going on here. So when we finished the presentation, I went up to them. Turns out they were cousins. And her parents had started a home inspection business here in Florida, which was doing in excess of 4,000 home inspections a year, a business that employed 18 members of their family. And the reason they were staring into space was they knew that while her parents were still in good shape, in their 60s and insurable, someday they would not be. Remember, everybody in business is going to do one of three things. They're going to die, they're going to retire, they're going to become disabled. What then? And while this couple was staring into space, they knew that when that date came, her parents were out of the picture, her brother was going to step in and insist on taking over the business. Her brother, who'd been married and divorced 3 times and had serious drug and alcohol problems. I cannot tell you how many times I have seen in family business situations where the one child who's least capable and least competent will insist on taking over the business, and they will, by bullying their way in, they'll destroy the business, they'll destroy the family. Again and again I've seen that. Okay? They are typified, best characterized as being the kind of people who are frequently wrong but never in doubt. The solution of the case I'm talking about was for us to approach the parents and get them to accept the fact that someone's a problem, and they entered into a buy-and-sell agreement with their daughter. But at the same time, while the son was a problem, he was still their son, and they felt compelled to do something for him. The answer was to buy life insurance and make him the beneficiary. And that's what I submit as a solution. In the cases you have where all the kids aren't going to be involved in the business, the way to be fair to the ones who are going to be on the outside is to buy life insurance and make them a beneficiary. That leaves the question of how much insurance. Well, if in this case the 2 boys are getting a farm worth $20 million, does it mean we have to give $20 million of insurance to the daughter Nancy? I submit no. The circumstances are different. The 2 boys have to go to work every day and make that farm succeed. Nancy will sit back and collect cash, income tax-free. Perhaps a third or a quarter of that amount would be sufficient to be fair to her. So think about maybe $5 million or less would be fair to Nancy because she hasn't got to do anything with the cash. Going on, the right people. As I said before, Bill and Sue, if this is going to work through transition to the boys, need to have the ongoing assistance of these key employees, Charles and Jane. So what do you do to keep Charles and Jane around? Remember, if people learn that ownership of business is going to change, they frequently begin looking for a job someplace else. They're afraid when ownership changes, they may lose a job, they look someplace else. So you've got to keep them around. The answer, a restricted bonus arrangement. It's nothing more than a situation where Bill and Sue approach Charles and Jane and say, look, we need you to stick around until we leave the business and the boys take over. You do that, and we'll tell you what. You go out and buy a life insurance policy that you own, each of you on your own life. We'll pay the premiums of that insurance. You own it, do what you want with it. Except you're going to promise us in writing that you're not going to touch the cash by the policy until such time as the business changes hands. And only that, if you leave before that time, you're going to pay us back the premiums we put in. That's the golden handcuff. Know also that as Bill and Sue pay the premiums on the insurance owned by Charles and Jane, that's income to them and deductible by the farm. That completes my presentation, except to remind you this is not just about saving taxes, it's also about family succession planning. Any questions?
Lou?
Yes?
This is Jason Torsky here at Lincoln Benefit Life as well. And Sophia, I'm not sure if there are any questions here, but I do want to spend just a couple of minutes sharing a few solutions that I think tie in very nicely to what Lou had shared here today. So before I do that, I just want to make sure if there's any particular questions regarding the farmer's presentation. All right, well, very good. Well, let me just share a couple of that I think fit very nicely into Lou's presentation. Again, I'm Jason Torsky with Lincoln Benefit Life, and I'm a sales VP that works closely with First American. So thank you, Sophia, for allowing us the opportunity to share, I think, some information on a very important topic, you know, whether it's a cranberry farm in the Northeast or, you know, a corn farm in the Midwest here in Nebraska where we're located, or possibly a ranch out in the southwest part of the country. You know, this is a very important topic, and I think Lou provided us very good planning strategies. And along with those planning strategies, it also is very important to have the solutions that you can work with that. And as you mentioned, whether it be estate equalization, possibly using our Legacy Secure Second to Die product, or if you're doing a buy-sell or possibly a key person insurance, we have our guaranteed death benefit products that are set up not only to provide a guaranteed death benefit at a very competitive price, but we look at it beyond the spreadsheet and beyond what's the premium of the product, and look at it more, what's the overall value that's built in, and how can we provide flexibility and possibly an exit strategy down the road, not if things will change, but when things change for the customer. And for example, with our Legacy Secure Second to Die product, again, it's a guaranteed death benefit, but we provide at no cost an automatic feature in the policy where in the 10th year, there's a window where we allow the customer to exit the contract for whatever reason and get 90% of the premiums that they put in back. Or in the 15th year, they can exit with 100% of the premium they put in. They get that back. So whether they no longer need the coverage, whether maybe there's a product that fits their needs better at that time, they can exit with the majority, if not all, their premium during those windows. Beyond that, we have significant flexibility on a guaranteed surrender value basis, in some cases going out 30, 40 years, where they have guaranteed surrender value where if they need to exit, they have the ability to get a significant amount of cash back to make a decision that suits their needs better at that particular time. On the single life side, we have our Legacy Secure and Legacy Well products, where we are able to provide them with guaranteed return of premium as early as year 8+. So I just wanted to share a couple of these features with you because, one, you have the planning strategies, but two, you also need to have the solutions that work with that. And I think that here at Lincoln Benefit Life, we have a number of those that can assist. And within First American, they're well-versed with our products and what we offer and the bells and whistles that we really can provide. So we encourage you to reach out to them, and we also will be reaching out to you as well to see where we can be of assistance. So with that, I will turn you over to Sophia and see if there's any other questions.
Does anybody have any questions for Lou or for Jason? Well, I want to thank everybody for attending. I will send a quick survey right after the meeting. Again, thanks for participating, and I will be sending along with the survey the presentation as well if anybody wants to look at it your convenience. Thanks again.
Oh, and Sophia?
Yes.
The one thing, too, I wanted to mention is all the material as far as with the farming and ranching brochures and customer and producer material can be found at our website, which is LBL, as in Lincoln Benefit Life, LBLsales@allstate.com. So LBLsales.com. It's under our advanced marketing material. And that's not only with our estate planning, but business planning as well. And we have a variety of different topics. So I encourage everyone to take a look at that.
Great. Thank you.
All right. Thanks so much.
All right. Have a good afternoon.
All right. Goodbye.
Bye-bye.